What is the S&P 500's annual average? I've heard this asked 10 billion times, and obviously it depends on the time frame, but I want to walk you through what I find is a fantastic and wonderful article from Dimensional Fund Advisors going back to 1926 when we have reportable evidence and data from the S&P 500. So we're almost coming up on 100 years of available data. And they talk about that going back that far, almost 100 years, the average of the S&P 500 is around 10%. 10% even, because there's been a lot of positive 10s, positive 20s, positive 30s and 40s. There's been some negative 10s, 20s, 30s, and most of us have lived through a major financial crisis and or several recessions. That is kind of what we remember more often sometimes than the big wins. But what they find fascinating in this article that we'll link in the description is over that almost 100 years of data, what's interesting about the S&P 500 is if you give it a margin of error of 2%, so somewhere between a corridor of 8 and 12%, how many times has it actually hit 10%? And the interesting thing is it's only 6 times. In that, between 8 and 12%, it's only hit between 8 and 12% 6 times. Every other year has been volatile. Positive 20s, positive 30s, 40s, 2, 10, 20, minus 10s, minus 20. So even though in our minds we might anchor on, hey, it averages 10% per year, in reality, the scatter plot tells a completely different story. When it comes to investing, though, throughout your entire life and specifically in retirement, it makes the most sense to invest as long as you give yourself time. Time is one of the greatest earners in our retirement journey. Here's another chart that Dimensional puts out, Exhibit 2, frequency of positive returns in the S&P 500. Again, data going back almost 100 years. So if you give yourself 1 year in the S&P 500, 75.2% of the time, if you look 365 days forward, it's going to be positive. 75% of the time, it's a pretty good bet. If you give yourself an additional or a total of 5 years, that percentage of it being positive 300 or 5 years later is 87.7%. At 10 years, it's 94.7%. Almost 95% of the time, or in 10-year periods, the S&P 500 is positive. So it's still a gamble, right? It's not 100% guaranteed, but the longer we give the market time, the better our outcomes will be. So going back to retirement planning, though, that we talk about in other videos, having different set-aside buckets, cash, protection, and risk, that allows your risk buckets to be able to have time to experience those growths and to experience the gains of the market. That's how we can continue to remain retired, keep up with inflation, and then see that growth. If we're trading on a daily, a weekly, or a monthly basis trying to see returns, in my opinion, that's not the best way to be successful in retirement. If you give the market time, it will earn money for you. But again, it's in a significantly different way. It's not 10% every year. It's a scatter plot of 1 million different data points that has averaged 10%. So have a great day. Thanks for tuning into the channel. Please hit that like and subscribe button. Tell your friends about us as we continue to provide educational content for retirement.